Gaurav Nair. He's from the Infinity Anchor Fund. He's an actuary. Over to you.
Thank you, Rick. Good day. I'm Gaurav Nair. I'm one of the co-founders of Geltec, and I'm the CEO of Infinity Fund Managers. Today, I want to talk to you about Infinity Anchor Fund. Infinity is a Section 12J investment, and this gives investors a tax deduction. Up front, I'd like to define some of the jargon used by Section 12J fund managers. There's two ways that Section 12J fund managers measure their returns. One is a gross capital return, and the other is a net capital return. And what the difference is, the gross capital return is measured on the full investment an investor makes. Let's say, for example, 100 Rand. Whereas the net capital return takes out the tax deduction the investor gets. So the return is measured only on, let's say, 55 Rand. And what this does is this inflates returns compared to a gross capital return. And it'll be relevant in my presentation. So at Geltec, we prefer using the gross capital metric. However, you'll see that we also mention the net capital return, and the reason being that so that you can compare our returns with the rest of the industry. Today, I'm here to talk about two investment options. Infinity Performance is the fund that we've been running for the last few years. It was the top performing fund in its class in 2019-2020, and it's currently tracking a return of close to 16% per annum, and this is on net capital. We had 100% of our capital invested at the end of the financial year, and for the last few years we've been paying a 6 monthly dividend, with the last dividend being an annualized amount of 5.2%. We also charge our performance fees on gross capital, resulting in low performance fees for our investors. I'll also talk about Infinity Stable a bit later on in the presentation, which is a Section 12J product that is underpinned by guarantees. And we designed this to be the answer to the objections that people who are hesitant to invest in Section 12J or hesitant to invest in South Africa have raised. First, about Infinity Performance. We invest equity capital into asset rental businesses. By their very nature, these businesses are asset-backed and have contractual or regular revenues. And so this means that the risk profile of these businesses is relatively lower. They also lend themselves to a clear exit strategy, which we plan with the management of the business. We target investing 100% of the funds under management. This is compared to some of our competitors who target investing only 80% of funds, leading them to take on unnecessary compliance risk. And finally, as mentioned, we charge our performance fees only on gross capital. I'm now going to take you through a couple of investments that we've made that are noteworthy. We made these investments, so the first investment, Secutech, we made almost 2 years ago now, and it's performed wonderfully. It has maintained its zero default rate from its customers throughout the investment period and even throughout COVID. What it does is it rents out security technology. So we're talking about smart alarm systems, electric fences, cameras, etc. And this makes sense with respect to the zero default rate with the importance of security in South Africa. We are currently running at a 9.73% IRR with them, and that's excluding any tax benefit. Next up is Rise. Rise deploys and owns high-speed internet infrastructure. We made this investment in June of this year during the COVID crisis. And what we saw with COVID is Rise's demand went through the roof, with many people working from home, with video conferencing, etc., increasing, and the need for high-speed internet access increasing. We're currently tracking a return of almost 9.5%, and that's excluding any tax benefit. With COVID, we went back and rebuilt our pipeline from scratch, really with the lens of looking at which businesses can perform well in a COVID environment, as well as after COVID, with the advent of vaccines, etc., coming through. Right now, our pipeline, 80% of it is exclusive to us. The returns excluding any tax deduction, will be between 10 to 25%. The pipeline is from 150 to 200 million rand in size, and it's across numerous industries. Now to talk about the performance of Infinity Performance. Our average dividend yield has been almost 5% per annum. For comparison purposes, the net dividend yield is close to 9%. Our returns on gross capital has been 5.78%, and we're projecting an IRR of close to 16% on net capital. And in 2019, we had 100% of our capital invested. Now, many funds out there do not publicly publish their performance. So in order to assist investors with making decisions, we decided to compare ourselves to our largest competitor so that they can make an informed decision. As you can see, our gross dividend yield is almost 5%, which is significantly higher than our largest competitor. We're tracking an IRR of almost 16% after fees and taxes, also significantly higher than our largest competitor. At Infinity, we managed to grow the net asset value, excluding any dividends. Our competitors have seen their net asset value shrink, and what this means is that the investment is now worth less today than the amount that the investor initially put in. Infinity charges the gross performance fee, unlike our competitors, and we target 100% of capital deployed, which we had at the end of February 2020. Also, we only pay dividends out of profits. I mentioned the shrinking net asset value of our competitor, and hence you can interpret that they have been paying dividends out of capital. We have an accessible minimum investment size of 200,000, and we proudly publicly report our performance. This graph here just shows you graphically the stats of Infinity compared to our largest competitor, and it really does speak for itself. This picture here is quite interesting. What it shows to the left of the line is it shows the actual performance of Infinity Performance compared to our largest competitor. To the right of the line, it shows the projections done by ourselves for our fund and by our largest competitor for their own fund. As you can see, through the actual performance, through the actual period, our largest competitor's performance dipped, and they're projecting this dip to continue forward. And if you look at it over 5 years, this results in quite a significant difference in performance of up to 15% on gross capital. Now I want to talk you through Infinity Stable. This is also a Section 12J product, and the investments made by Infinity Stable have income streams underpinned by guarantees. The return of capital is also underpinned by a guarantee, and this allows us to have a predictable exit, and investors will know that they will get their investments back timeously. Finally, the returns are predictable. We charge no performance fees on Infinity Stable, and there's the same low minimum investment size. We came up with Infinity Stable as an answer to objections raised by people who were hesitant to invest either in Section 12J or in South Africa. Really, these were questions around the risk of performance with an unlisted investment, the risk of exit, and finally, continuing to invest in South Africa. Infinity Stable works by investing, similar to Infinity Performance, into the equity of asset rental businesses. However, our partners in these investments are large institutions that have great track records in the asset rental industry. And what they do for us is two things. They provide a guaranteed exit at the end of 5 years, and also they guarantee a minimum income stream. What this results in is a predictable return for our investors with a timeless exit. Infinity Stable is targeting a net dividend yield of 3.69%, a rate of return on net capital of close to 11% per annum. That's after all fees and taxes. Guaranteed earning streams in the underlying investments, guaranteed exits of the underlying investments, and the quick deployment of capital, with 100% of capital being deployed by March 2021. Over here, we compare Infinity Stable to our largest competitor. in this comparison, Infinity Stable, with all its guarantees and risk mitigations, is compared to our largest competitor that does not have these. Hence, Infinity has a limited risk profile. The investments have a guaranteed income stream as well as a guaranteed exit, which our competitors' funds don't have. There's no performance fee charge at all on Infinity Stable. We have the predictable deployment of capital and, of course, the same accessible minimum investment size. When we compare Infinity Stable's projected returns to that of our largest competitor, you can see that the performance is expected to be virtually identical. However, our largest competitor has none of the risk mitigants that Infinity Stable does. Also, for comparison purposes, we compared Infinity Stable to a 5-year fixed deposit. Since Infinity Stable is a 12J investment, upfront, you get more of your capital invested since you get a tax deduction on your taxable income. So what this means is that even though both investments are expected to earn a similar amount, you start off with a much lower capital base in a fixed deposit. Thank you very much. If you'd like to have a meeting, please go onto the website. I look forward to chatting to you guys directly in the breakaway session.
Gaurav, thank you so much for that. It's very interesting. But 12J is an interesting asset class, and it hasn't had the best name due to some of the constraints you've mentioned, liquidity, as well as what is being invested in. But if you look at 12J funds, currently the big marketing message is you're going to save on tax, and not the underlying investments. Now, I think you're the first presentation that I've actually seen what the underlying investments are and what the returns are. Don't you think the industry needs to set standards for transparency to actually see what the performances are?
I totally agree with you, Rick. So what we always say when it comes to a Section 12J investment is that the investment needs to make sense on its own, and the tax deduction then is a risk mitigant or performance enhancer on top of that. And what we have seen is a concerning lack of transparency in the industry into what portion of assets are invested and what's sitting in cash. A lot of the funds are sitting cash heavy. Lack of transparency in the fee structures. And just the focus on the tax benefit only, which of course is misplaced.
Yeah. I think when the transparency increases, the support will become more significant. What do you think about the adoption rates of 12J investments? Is it to what you would have expected?
So 12J was introduced as legislation in 2009, and for a long while it just was not, there was no interest. And only in about 2016 did adoption start to increase after Parliament loosened some of the laws and made it a bit more user-friendly. The adoption rate has seen exponential growth. However, with that exponential growth, a lot of people have realized that some of the investments that they went into, the fee structure didn't work as they thought it did, etc. And so we're definitely pushing for much more transparency in the industry.
Yeah. You showed a return of around 9%, if I remember correctly. What would the total benefit be if you include the tax benefit?
So the total benefit comes to almost about 16% when you include the tax benefit. Now, we're investing in businesses that are asset rental businesses. So on the one hand, you don't have the chance for like a tech business having the next Facebook. But on the other hand, the risk profile is backed by assets, you have regular revenues, and so it's a relatively lower risk business.
Yeah. Gaurav, thank you so much for your time. You're from the Jaltec Infinity Anchor Fund. Interesting name, by the way, and good luck with the ventures.